What is going on, guys? Welcome to Stock Talk with Nico Kritikos. Today, we're going to be checking out Estee Lauder stock once again because a couple months ago, I made a video on this stock. It fell like 25% or something crazy. And just the last couple years, ever since, this stock peaked the last day of 2021 at $370 a share, and now we're all the way down to 73. So the last couple years has just been a tragic run for this stock, and it's really because their sales and their profitability are down. So revenue, as you can see, once again, starting in 2022, these last 2 to 3 years have just been flat, and really they've been downtrending a little bit. The last 12 months, it's been pretty much flat, but they need to be growing revenue, and net income is just horrific. $3.3 billion of net income 3 years ago. Those are good numbers. And then the last quarter, 200 million of net income. Keep in mind, this is a $26 billion company, and so I don't think I bought the stock when it fell most recently, but I would say, okay, let's look at the facts here. So the good thing with this company is that they have pretty significant market share, right? As of 2 years ago, 1 to 2 years ago, they had 23% market share, right? In these different markets, 14% market share in skincare, and then 8% in skincare, right? So it just they're not the biggest player, but they are a significant player in many different markets. I read this Motley Fool article, and it said that the reason their numbers are down are really just because of one-time costs like this talc powder settlement charge and restructuring costs. So, if that's the case, that's very good news, right? That's very good news because that means that these numbers should go back up. And you look at what analysts have been doing, it's supposed to drop a lot this year down to $1.50. But then the following year, it's expected to go back up to 2.7. So if that's the case, you're only paying 27 times that number. And if you go to their P/E ratio history, you can see that 27 times is the cheapest it's traded at, right? So you're getting a really good deal if that's the case. But that's only if that happens. Who knows if that happens? That could easily be postponed. And then this number, $1.50, well, then you're paying like 49 times earnings or something like that. So now we're paying right around, let's see, do we have a 49 anywhere? We're somewhere around here, right? It's going to be right below there, which is still, look at this chart. That's not that bad. But you're probably not going to pay 50 times earnings for a company that's not growing. So revenue is expected to be down again, and then it's expected to go back up 4%. So I don't know. This is a tough one. This could be one where they struggle to grow and the stock just trades at 20 times earnings for who knows, the next decade. That is very possible. That's why there is some risk here. But paying 28 times earnings is, historically, you don't ever get it that cheap, right? Now this could be the beginning of the end for this company. This could be the downfall, right? And so maybe it doesn't go back to trading at 60 times earnings. That's very possible. I don't know. I'm not, you'd have to be super knowledgeable about all the different companies, influencers, customer demand, and the products for makeup and skincare and all that stuff, which I'm not. But I can at least look at the numbers and say, okay, this company's doing $15 billion in a year. So obviously, and they have, these decent market share numbers of between 10 to 20%. So obviously they're somewhat relevant, right? They're not a small player by any means. Um, so there's that, right? They do have some, they got something. They got a market, they got customers, they got distribution and all that stuff. Um, they cut the dividend, which is good. That gives them more flexibility with cash flow. The debt to cash ratio, not very good. 9 billion of debt and only 2 billion in cash. That's really bad. That's a problem. Shares outstanding is flat, kind of pretty impressive, honestly. But I don't know if I were to invest in this, it's interesting because if they put those numbers back up, the stock could double. We could see the stock be 250 bucks again. I would not doubt it. But, I could have said that back in November. And if I would have bought, I guess if you would have bought it during this period in November, you'd still be up on your investment. But still, the stock hasn't, it's not anywhere near where it was a year ago. So if I were to invest, which it's possible, I might, but I would keep it small because there is some risk. Now, you're also getting a 3% dividend, which is nice. That can help kind of, at least you're getting paid while you're waiting. But still, with these turnaround plays, sometimes they take well over a year, right? Look at Nike, look at Disney, those stocks. It's not like when they fall, they shoot right back up. So you got to be careful with that. But it's an interesting one. I don't know if this is a company that's just, going to be obsolete now. I feel like they're with the industry they're in, the market share they have. Um, I don't know. I feel like they have a chance to turn things around here. So we will see with this one. I don't know. How I said, I'm not super eager to buy yet, but if I were to buy, let's say in the next week or two, it'd probably be a very small position. So that is my analysis. Thank you for watching, and I will see you in the next video.